In this video, I look at the 4 major issues that can go wrong with a guarantor home loan. And this video is thanks to a question by Kira, who asked if we could make a worst case scenario guarantor video. And if you have any questions or if you'd like for us to cover any videos, I'd love to hear from you, and you can leave a comment below. 1. The method of guarantee. There are really 2 types of methods with the securitization of guarantor home loans. The first is standalone, and it looks exactly like this. It's where we've got your guarantor's property in black and we've got your property in blue. Now let's say you've got a $500,000 purchase price. As we know, 80% or $400,000 secured against your property and $100,000 secured against the guarantor's property. All pretty simple, all makes a lot of sense. It's when you pay down the $100,000 home loan that we can release the guarantor's property, and it's all very simple where we've got it all standalone. However, there are some lenders that don't do or use this methodology. Rather, what they'll do is they'll take both your property and the guarantor's property and they'll what's called cross-secure it. In the background, what you won't see is that whilst you've got a $500,000 loan, so the same as before, a portion of that will actually be secured against the guarantor's property. Generally, it's closer to 25% instead of 20%. And that'll essentially mean that you might be guaranteeing more than the $100,000, maybe up to $125,000, and in some cases even more. And the first trouble with this is that whilst you might have paid down $100,000 in debt, when you go to release the guarantee, it's not so simple. The bank will need you to complete a full valuation on your property here, and they may actually require you to pay more off the property than what you expected. So the first mistake to avoid is to first find out whether your lender offers a standalone or a cross-secured property, and whether the lender will be requiring more than the 20%, that is 20% plus a buffer. 2. Priority. So the next issue becomes when we go for a priority over your guarantor's home loan. Now this may not make a lot of sense right now, but let's delve into how this all looks and how this all feels. So when we look at your guarantor's home, let's call your guarantor's home worth $700,000, right? And they have a home loan against this property of $100,000. Now let's call this Bank A. Now when Bank B goes for that $100,000 guarantor home loan, what will happen is that Bank A, which is the black, will have to consent to Bank B. Now, Bank A has what's called a first priority, and it essentially means that if anything were to go wrong, they could sell the property with a moment's notice. Now, when we look at a priority, unless it's with the same bank that is Bank A, Bank B will have to go second. So essentially what that means is that Bank B will have to get Bank A's consent to sell the property. So if Bank B wants to sell the property, if Bank A says no, then they don't hold the right to sell the property. Now the trouble is that whilst Bank B might be cool with everything, if Bank A doesn't offer what's called a deed of priority, also known as a priority of consent, if they don't offer the ability for Bank B to go second, then the guarantor loan is all off, because essentially it means that Bank B will not have any securitization or any recourse. That is to say, to sell the guarantor's property in the event that worst case scenario happens. And the trouble is that most banks won't send the deed of priority to Bank A until the loan is approved. And it's a big issue because until we know whether or not Bank A is cool with Bank B going second, we're a little bit in limbo. So you may want to slow things down and wait to offer your approval until you've got consent from Bank A. 3, encumbrance. And this is a big one. We see major problems when it comes to guarantor home loans because a lot of times finance is very complicated and doesn't make a lot of sense. Let me show you a recent example. So recently we had a customer who had a guarantor and their property was worth quite a lot. They had told us they only had one loan against it worth $400,000. And for what we were looking to do, it was perfect. We had heaps of equity, no troubles whatsoever. In the background, the guarantors held other properties, 2 investment properties to be precise. And when everything was set up, the banker had told the guarantors everything was standalone, meaning that the property we're taking, and this is property 1 here, wasn't secured with properties 2 and 3. So we were laughing. And when we did a title search, which is to show whether or not there were any other encumbrance listed, and encumbrance is essentially the loans listed against the property, it was sweet. We could only see one loan. We couldn't see anything else. So we thought we were in the clear. Come settlement, when we were requesting, the bank was requesting a deed of priority, we found that in actual fact that there was an $800,000 priority notice listed against this property. The guarantors were shocked and they went into the branch to find out what was going on. Little did they know that the bank had in actual fact cross-secured all the properties and hadn't told the guarantors. It essentially meant that their equity position was nil. They had no further equity to produce. It's because this lender had undervalued the units associated and had LVR restrictions. In short, it collapsed the guarantor home loan because we weren't able to get any additional equity based on the encumbrance being $800,000 being well and truly over the value of the property. Furthermore, many lenders don't allow you to have multiple securities as a guarantor home loan. So if you do have your parents going as guarantor, you want to make sure they double check with their bank and loan contracts to ensure that everything's standalone and nothing's been put together in the mix like this scenario so that we know exactly what the equity position is. 4, the removal of the guarantee loan. In some cases, guarantors will want to sell their property to either retire or downsize. Now, this is a big issue when it comes to guarantor home loans. It's because a guarantor home loan is a 30-year term. And whilst we can remove them, typically speaking, within 3, 5, and even 10 years, the trouble is it's based on the market. And no one knows what is going to happen in the next 3 to 5 years. And whilst typically we can remove it, it doesn't necessarily mean that's going to be the case for you. So let's take an example of a guarantor wanting to sell their home and what that will mean for the guarantor's portion. So again, we've got the guarantor in black looking to sell their home for $700,000. And let's just say that they don't have any debts. Okay, so we know that there's a $400,000 loan against your home and $100,000 against theirs. So when they sell, what will happen is that this lender, unless we can consolidate, this lender will hold the $100,000 in sales proceeds in a term deposit. It essentially means that your guarantors won't have $700,000 in sale proceeds, rather $600,000. So it's something to be very mindful of, and if your parents or guarantors are considering selling their property, it's worth noting that this might happen to them. Now, the only way we can get around that is whether or not we can revalue your property. And if the valuation has increased significantly to support the equity position, to support the $500,000 in lending, then that's another way around it. However, it's worth noting that worst case scenario, that the $100,000 will be put into a term deposit and will be held there until we can either release with a refinance in your property, or whether they get a new security or home, which we can then substitute for. And there you have it. They're the 4 big mistakes I see with guarantor home loans and the 4 mistakes you want to avoid. Here at Hunter Galloway, we get home loans approved. So if you live in Australia and looking for a mortgage broker, we can help. Simply visit us online, huntergalloway.com.au, or call us here on 1300 088 065. Thanks for watching. Remember, if you like this video, hit that subscribe button, and I'll catch you next time.